Welcome back, investors, to Ticker Time News. I'm Adam, and Palo Alto Networks, ticker symbol PANW. PANW. Off to a rocky start already in this live stream. They jumped over 8% in the after hours after they posted Q4 earnings that were pretty good. And there were a couple of specific reasons for that, too. Now, after the closing bell, they reported EPS of $2.39, which did beat by 11 cents, and revenue came in at $1.55 billion. Now, that was a 27.2% year-over-year gain, and that came in line with expectations. Well, that's not so great. The growth is great, but being in line with expectations, not so much. It's a coin cost, right? But Palo Alto did guide Q1 EPS and revenue also in line with expectations. Again, not so great for the next quarter, but they did guide their fiscal year 23 EPS and revenue above expectations. So that was good. Now, two other important bits of news, and they are Palo Alto approved a 3-for-1 stock split. And then they also increased their share repurchase authorization to a cool $1 billion, to $1 billion. Now, that will help with the stock appreciation over time as they use that money. And with their stock kind of flat, moving sideways, definitely a bit on sale from its premium all-time high, yeah, they can use that pretty wisely, especially over the next coming months when there should be increased volatility in the markets. One of the main reasons, midterm elections. Now, the stock split, that does not change the company in any fundamental way. It does say, however, the stock split, it will make the price per share seem lower. Therefore, market participants will psychologically believe they are getting a better deal. That's it. That's the stock split. Psychologically, investors think they get a better deal, right? Now, if we round up to the after hour per share price, and it's at 148.66 right now, let's just round it up to a cool $550 a share. Then, after the 3-for-1 stock split, we'd be looking at what, around 182, 183 or so. Let's go with that. $183 per share. That would be the pre or the post stock split price based on the price right now and rounding it up to an even number. So at 550, it would break down to $183 per share. So if you're an investor, especially if you're new to investing, or you just came across Palo Alto Networks, maybe you're just starting to look into cybersecurity, and that's how you find your way to Palo Alto Networks, looking at a stock that's, $550 versus a stock that's $183 a share. Well, I can get more for my money at $183. So there's a psychological role that stock splits play with investors and market participants. So, that's it. Also, doing a stock split and bringing your per share price down a little bit, that also helps options traders, because when you buy an option contract, you're buying 100 shares of whatever that company is. So 500 times 100, you're looking at a pretty good chunk of change there just to trade options. So lowering the share price through a stock split also helps with that. But then, the stock appreciating with $1 billion that they can spend on buying back their share, yeah, that's looking pretty good. I really like those two things from Palo Alto Networks. Now, I haven't had time to dig into the earnings call or anything like that. This is just fresh, hot take, and those two important bits of news. Now, looking at the chart, Palo Alto has been bouncing sideways what is that, since May 19th on its earnings day, its last earnings, and that was its bottom on the 19th of May. Now, I'd imagine that after this after hours bump of 8%, which is where the green highlighter mark is, that's where the stock is currently being priced at, near $150 a share. I suspect that it will probably either start to slowly come back down, or maybe just continues to move sideways in the short term. But that was a very tight trading range that it was in, moving sideways going back to May 19th. So, maybe it works its way back down into that range again, and just continues to move sideways, or the range opens up. Maybe the range ticks up a little bit higher with this new information from their earnings. Okay, let's move on to the broader market. And last Friday's live stream, we talked about in the live stream, let me just get this opened up. Yeah, it was a nasty day. Nasty day. Everything down like 2% or more. But last Friday's live stream, what we talked about is partly what moved the markets today. Now, this coming Friday, you can see it written in yellow here, on August the 26th. Now, it starts before Friday, but Friday is the big day. Friday, August 26th, Fed Chair Powell will give a speech at the Jackson Hole Economic Policy Meeting. And this speech is what caused the stock market to move noticeably lower, with the major indices closing just above session lows and nearly right on the bottom line of this week's weekly expected moves. All of them did it. They're practically sitting on it right now. And I'm going to talk about later what that means for the rest of this week. But first, focusing on the market in particular. Broad-based selling was also fueled by the lingering feeling that the market is due for a pullback after July's 9.1% upside move in the S&P 500, 12.5% in the Qs, and a 10.5% in the IWM, which is the small caps. Now, the feeling of an overdue pullback was reflected by the price action seen in meme stocks or momentum stocks, however you want to call them. AMC today, it lost 42%. AMC, let's pull it up real quick. Ticker symbol, same thing. AMC. 42% drop today. Look at that, wild drop. And that's because the past couple of weeks, there's been these insane moves up. Like, what is this one right here? Let's see if I can get on it. August 5th, it was up 18.8%. Then you've got Bed Bath & Beyond, 3 B's and a Y, BBBY. This thing has just been moving crazy. It lost 16.2% today after being down over 40% on Friday, okay? 40% on Friday, down 20% last Thursday, and down 11.7% last Wednesday. And of course, the big run up as well. I mean, they had a 24% run up in one day on August 15th. Just crazy. But these came crashing back down today. These were huge moves, and huge moves to the downside. The quicker something goes up, the quicker it'll come down. There's this saying in the stock market that stocks will take the steps up, but the elevator down. I don't know who came up with that saying, but it is true. And we've seen it in 2022 so far. But this type of move that you see on the stock, this is not normal stock behavior. Shooting up like a rocket and then falling straight back down just as hard. These stocks benefited from the speculative excess during the recent rally, but they are now suffering from the speculative excess being wrung out of their stock prices, while also facing some additional company-specific news, like Bed Bath & Beyond. It had some company-specific news also helping it to drop even harder than it ran up. Now, the material losses, they proved to be a risk-off factor as they undercut sentiment and weighed on most stocks in today's session. Now, we also talked about this last Friday. Why do tech stocks and growth stocks get hit the hardest when the 10-year Treasury goes up? Now, let me put the QQQ up here so you can see that. That was down hard today, 2.6%. And again, it is sitting right on the bottom line for the weekly expected move. But let's get to this question. I forgot a very important part. I neglected to share this with you last Friday, and that was the rate of change. Okay? The rate of change. How quickly or slowly things change. And I'll talk more on that in just a moment. Now, I showed you on the chart during last Friday's live stream how the 10-year Treasury and tech stocks and growth stocks can all move together in the same direction. However, the cases when they move in opposite directions are the times when there is the quickest rate of change. Meaning, the 10-year Treasury will spike up or down, causing tech and growth stocks to also spike in the opposite direction. That rate of change being much higher is what can cause the 10-year Treasury to pressure tech and growth stocks, as we saw today. The 10-year yield pushing above 3% also helped to fuel some selling efforts today. And that's because of the rate of change. How's it going? Glad to see you here. Okay, let me just say that one more time. The rate of change. If the rate of change, meaning if it's up 0.5% or down 0.25% or 0.1%, then a lot of times tech and the 10-year Treasury will move together. And we saw that on the chart. However, if that rate of change is big, there's a big spike in the 10-year, then that can cause a big spike in tech and growth stocks. And if the 10-year spikes and the rate of change is big, that will pressure tech stocks and growth stocks in the opposite direction. Now, my apologies for omitting that on Friday's live stream, but that's an important part, and it really clicked in my head that, oh, I forgot to mention this part during that live stream. So I wanted to make sure that I mentioned it today because there was an opposite effect today with the 10-year rising in tech and really everything. But tech did get hit a little bit harder. Growth got hit a little bit harder. So I just want to make sure I mention that. Now, the 10-year, and let me pull that up real quick, US10Y. The 10-year today, it rose 5 basis points to 3.04%. That's, in my mind, that's a good thing. We want to continue to see this. The 10-year is now above its 50-day moving average. It closed above it on Friday, just barely, and today it closed a little bit further above that 50-day moving average. And why is that important? Because the 50-day moving average is a very important moving average. It means bullish above, bearish below. And right now, in the short term, I do want to see the 10-year rise, just like I want to see the 2-year contract. Okay? I want to see that 2-year come back down. So we get out of this inverted yield. Because when you think of the business model of banks, and one of the biggest ways they earn money, banks earn money by borrowing short term from the Fed and then lending out long term. So when the rates are normal and we're not in an inverted yield, that business model works for banks. But when that yield is inverted and borrowing short term costs more than the bank can lend long term, then the bank is losing money or not making nearly as much as they could if we were not in an inverted yield. That's why an inverted yield is so important. Now, what do banks do when the yield is inverted like this? When it's costing them to make a loan? Well, they tighten their standards and they stop making as many loans as they might have when the yield's not inverted. And if the bank is tightening their requirements for loans and the bank is making less loans, what is that doing to the economy? It is slowing the economy's growth. This is the effect of an incoming recession. And that's why yield curves can be a leading indicator to a recession. Because when the yield inverts, everything is fine with the bank. Maybe they've slowed down a little bit because they can, see the yield coming, the yield curve coming. But once that yield curve hits, that's when the banks really start to slow down on lending. And if money isn't being lent, then guess what? Companies are not expanding. And if companies are not expanding, they're contracting. They're laying people off. They're not hiring as heavily as they were, or they've cut out hiring altogether. We've heard that from a whole list of companies. That's what gets us into that recession. That's why the yield curve is a leading indicator. And the yield curve the Fed pays attention to the most is the 10-year and 3-month. Now, that's not inverted yet, but it is on a steep decline and quickly approaching. Let's look at the 2-year. US 02Y. Euphoria, my goodness, getting tongue twisted there with euphoria. Yes, euphoria, it's over. It is over. That's another indicator of why this market sold off so much. And it's why I cannot remember if it was last Thursday or last Wednesday. I said on the live stream that I started building a short position, and oh my gosh, did that pay off today. Big time. It was beautiful. Beautiful. My gosh. Okay, enough about me. And I bet, I should have read that. I should have read that next comment. And I bet your short position is paying off. Oh my goodness. I should have just kept on reading. Yes, it has been paying off. This market has just it was way too oversold. It hit resistance, S&P trifecta of resistance, and it broke down. So even if it was just a short-term pullback, setting those up, they're good to do. But you have to watch for these signs, and that's really why the live stream is every day, so we can talk about what happened in the market, why it happened, and hopefully we can make sense of it and use what we've learned to make these trades that work in our favor so we can beat this crazy market. Okay, the 2-year yield. We have this resistance line drawn, and it's still above it. It's really like at 3.28% is like where that line is at. So it's hovering around it right now. It is above it slightly. I really want that 2-year to come on back down. The longer we stay inverted, I'm afraid the deeper or longer the recession will be. So just keep that in your mind. So it's at 3.31% right now. It did close up 8 basis points to 3.33%. Okay, moving off of the yield curve rant that I just gave. The selling was broad-based today. I know I keep saying that, but it was broad-based today. And we can see that with the SPY being down 2.1%, SPX down 2.1%, the Q is down 2.6%, DIA, which is Dow Jones, down 1.8%, and the IWM down 2%. The dollar was the only thing strong today, which makes sense. And I've said this before. Let's look at the dollar real quick because I want to talk about it. It's important. I saw comment after comment. You go through stock twits or even just on Twitter, and you know, looking at the dollar or DYX, sometimes called Dixie. And there were so many people back here saying that the July 14th high in the dollar, that was it. You know, the dollar's done now. And what has the dollar done in the past several sessions? It has been aggressively rising. That was another sign that, whoa, wait a minute. This market, when the dollar goes up, the S&P goes down. So that's another reason to watch the dollar, because it can tell you right now, at least, there is this inverse correlation between the dollar and the S&P. I was one day away from buying SPY puts. Did you get any today? Did you my question is, did you get puts on Friday is the question. If not, did you load them up this morning? Because even going in this morning, the trade could have still worked out. Because once the market opened, it was already in the red, but it did escalate throughout the day. Especially, I think, somewhere around 10 a.m., maybe 11 a.m. at the latest Eastern time. That's when it just started up and to the right, started to climb, or the actual market down and to the right. All right, so the dollar super strong today, up 0.79%. That is a big move, and it now closed higher than, and let me lock this in here, the high from July 14th. So it did lock in a new closing high. The closing high on the 14th of July was 108.63. We closed today at 108.95. Can we get to 109? Because the high on July 14th was 109.29. Today's high was 109.09. So it did not break above the intraday high, but it did make a new closing high. And the closes are more important than the intradays. So that's why I've got two red lines at the top here. The first one to show, or the bottom red line to show the closing high, and then the top line to show the intraday high. I think there's a little more fuel left in the tank for the dollar to break this intraday high that was on set back in July, and I think the dollar could possibly even close above that intraday high. That's what I'm looking for. However, the dollar is getting a bit overextended right now. So I've got here at the end of my notes to talk about what to expect for tomorrow, because I think there's some clear signals on what to expect for tomorrow in the market. I got a few NVIDIA puts, but closed them out too early. Gotcha. No worries. No worries. One thing that took me a long time to learn when I started trading is don't get hung up on what you missed out on. Just be appreciative for what you were able to get. So it's all good, it's all right. No problem closing early. Okay. Broad-based selling. Let's continue on this. I jumped ahead a little bit here to talk about the dollar because I saw it on the chart there and I didn't want to miss it because it is important. But I think the dollar, if it's got a little more juice, I think it can close above that 109, which would be a pretty darn big deal. But also remember, too, a strong dollar, and I shared this in a note to Patreon members. I sent so many notes out today. I don't know if it was in today's note or if it was Saturday's note. But that in that note, I mentioned that a strong dollar, it can lower the earnings of multinational companies and emerging markets. It actually causes pain and less opportunity for emerging markets. But think of your Apples, your Alphabets, your Caterpillar, your John Deere, any company that does business in other countries around the world. Well, they're always converting currencies, right? A strong dollar hurts a US-based company who has to exchange for the dollar. When the dollar is strong, they actually come in a little bit on the downside, I would say. So it was in one of the notes that I sent out. I can't remember again if it was today or Saturday, but it was definitely one of those 2 days. Yeah, a strong dollar equals bad stock market. That's the best way to put it right there. There is definitely that inverse correlation when the dollar goes up, and when it's strong, it definitely hurts the market because those multinational companies, which the majority of them are big cap growth companies. Just think of Apple, the biggest company out there. It can hurt them when they're doing those exchange rates and exchanging for the dollar when the dollar is strong. You would think it would be the opposite of that, but it's not. Okay, let's keep moving on through my notes here. Broad-based selling. That left many stocks lower, but mega cap stocks and growth stocks, they were notably weaker today. If we look at the Vanguard mega cap growth ETF, ticker symbol is MGK. I've got to get my cursor back over here. MGK. It was down today, and it was down 2.6%. Now, if you look at the Invesco S&P 500 equal weight ETF, ticker symbol is RSP, mega cap growth down 2.6%. Equal weight S&P 500 down 2.1%. So there was a difference, about 0.5%, where the mega cap growths were down heavier than the rest of the market. And mega caps are a directional driver. If you had a compass, right, pointing to the Earth's North Pole or magnetic north or whatever it may be called, I'm not familiar in that part. Let's pretend that Apple is the North Star, North Pole, whatever it may be. Your compass is going to be pointing in the direction that Apple is moving because it has such an outsized weight in the market. So when you're in the stock market, paying attention to the mega cap growth companies, that's going to be a little, I wish I had a compass here to actually demonstrate, but I think you're getting the picture I'm painting here. That compass is going to move in the direction that those mega caps are moving in. So if they're going up, the market's going up. If they're going down, the market's going down. That's important. That even though it's 0.5%, it's still important. And then we can also look at for example, the Russell 3000 Growth Index. It was down 2.4% today. But the Russell 3000 Value Index, that was down 2% today. So value outperformed in a relative basis to growth. And you'd expect that on a day like today, when the dollar is strong, when the market is falling, when the speculative stocks like AMD or Bed Bath & Beyond come crashing down. And I tweeted out today a whole bunch of those stocks that were coming down. Now, let's look here, and I'll come back to the dailies here at the end when I talk about what I think tomorrow is going to do. If we look at the sector performance today, it was down. The only green is the dollar and the VIX. And I'm also going to talk about the VIX today too, when I talk about tomorrow. Because that's what the VIX did today, and what it does tomorrow, I think, is the whole key to the game. Okay. S&P 500 sector performance. It reflected the broad-based selling interest today, and also downside leadership from mega cap stocks. Every sector closed with losses ranging from 0.3%, which would be your energy and or XLE as the ticker there, to 2.8%, which was your consumer discretionary. Ticker symbol XLY, 2.78 to be exact. Now, consumer discretionary, ticker symbol XLY, and information technology, ticker symbol XLK, both lost 2.8%. And communication services, ticker symbol XLC, that dropped 2.7% today. Those three sectors are home to key mega cap stocks, and they were also at the bottom of the leaderboard today. Now, energy, ticker symbol is XLE, down 0.19% to be exact. I did the risk reward box here to visualize this. Let me open it up a little bit. There are many, many, many pundits talking about energy and oil right now. This winter is going to be tricky when it comes to energy, when it comes to oil, because of Europe and what's happening in Europe. Now, energy today, it closed ahead of its peers after WTI crude oil futures paired session losses. Oil was down big this morning, but it bounced back. And it bounced back due to a Bloomberg report citing the Saudi oil minister, who said that the disconnect between the futures market and supply fundamentals might actually force OPEC Plus and its allies to act. What does that mean? Cut the supply of oil. That's what it means. That's why oil rallied from its session lows. And we can see that in energy. Let's go to the 15-minute time frame. Let's open this up a little bit better so we can see it. Look at that. Look at oil today. I'm going to open this up. It'll be right here in the center of the screen. Oil today. Grab my highlighter. There was a big gap down right here. Big gap down. I shouldn't be using green on green. How about yellow? Big gap down, and then it sold off. It sold off. until about 10 o'clock Eastern. It started to rally, and then boom, it shot right up on that news. Oil was down under, my gosh, what was the low today? The low today, 77.63 for oil, $77 a barrel for oil. Yeah, that would definitely help to lower inflation. Oil going up will not. Now, before this news broke from Bloomberg about OPEC Plus, oil was falling, but many people were talking about oil could be in for a short squeeze. Can you believe that? I heard pundits talking this morning about a short squeeze in oil. That's just something. All right, let's go look at, let me go back to the daily and we'll look at oil because we're still on energy here. But I did just want to point out right here that with oil, energy, with where it's sitting right now, where it closed, I actually have to adjust this a little bit, and it's nearly on the flat line, meaning 50-50 chance of all right, come on. There we go. I need to pull this up to where it closed, which is right about there. So the risk reward right now for the energy sector, nearly 50-50, right? It's a split. All right, let's go look at oil. U.S. oil, one word, type it into TradingView. If you're not using TradingView yet, there is a link in the description. Sign up, doesn't cost a penny. Doesn't cost a penny. Okay. Daily view on oil here. Let me adjust it and then open it back up. That green bar, we've been using that thing as a support level for oil. It dipped below it last week, but then managed to climb back above. And you can see there's a wedge there. There's definitely a wedge there. With it climbing. Let me just put this from the bottom. Let's run it up like so. It's off a little bit. I need to change that color, not red. We're going up, not down. Okay, so the 20-day, well, I've got another one here. The 20-day moving average for oil. Going back to, it had already started to decline, but this right here, I'm going to trace the 20-day moving average. And now the 20-day moving average from this arc right here has been acting as resistance for oil every time. Every time. So it's starting to get squeezed here. And this is what some analysts were discussing, that the 20-day moving average, well, it's descending. We can definitely see that. It's acted as resistance. We can definitely see that. And it's also been making these higher lows at a time where it's barely making higher highs. So as it gets squeezed, as it continues to make these higher lows, it's going to hit that 20-day moving average, and that's just a simple moving average. And who's not to say it gets rejected? I mean, we had the same incline right here, and then it got rejected. We could be seeing the same thing. However, what they were pointing out is that price is getting tighter right here. I mean, you can see the candles are much smaller this time around than the place that I just pointed out. Those candles are much larger. So they were thinking that oil is going to break out and go and at least go test the 50-day moving average. If oil does that, energy is going up, and that also could affect the markets. Because if oil is going up, then so is inflation. Inflation's not coming back down. And we could run into a situation like last March, where we had 8.5% CPI reading, and then the next couple of months slowly tick back up until we reach that 9.1%. Who's not to say that's not what's going to happen this time around? We got 8.5%. Maybe September is 8.6 instead of under 8.5. It's a possibility. I just want to point that out there because it's an interesting theory, and it could play out, especially with that news from OPEC Plus there. Use the weekly expected move to sell puts. Let's put it up on the screen. In GDX today, the price was pretty flat today. Okay. Let me just clean this chart up a little bit here, and I'll pull that up. There we go. All right. When the dollar is strong, because there's an important part here too. When the dollar is strong, gold is not. With the dollar reaching the heights that it's at right now, I could definitely, excuse me, I could definitely see the dollar pulling back in a day or two. But it also depends on Friday. Because remember, Jerome Powell, we talked about this on Friday's live stream. Jerome Powell is giving a speech at the Jackson Hole meeting about economic policy, monetary policy. And I read through his speech, at least the one that's online. I don't know how accurate it is to what he's actually going to be saying, but it's not that bad. I mean, he's just saying things he's already said before, basically. But the market is getting concerned about a higher interest rate hike and hiking for longer. Because remember, this rally that we just went through middle to end of June, all the way through July, that summer rally, we can call it, that summer rally was front running the Fed pivoting. But I've been saying for months, the Fed's not going to pivot anytime soon. Inflation is just still way too high. All right. Gold right now is interesting. It's really going nowhere, right? I'm going to put it on a monthly time frame just to illustrate this right quick. Yeah, those candles are messed up. Let's press this button. So if we look at 2022, I guess I should have done weekly, but anyways, here we go. 2022 would be, I just placed a vertical line there. It's tough to see. There's a bunch of stuff on this chart here. But this purple vertical line, that would mark the start of this year. And gold, it started out, and of course with the miners, doing very well at the beginning of the year when oil was going up, when energy was going up. It had a good start to the year. The Ukraine war, that helped to push gold and, of course, gold miners higher. But since then, April down, May down, June down big. And now we're making these smaller moves down, and I think it can go lower. If you look over here to the left side of the screen, slightly above my head, there's the volume shelf profile. The area that sticks out the most, and it's two candles that go out this far, and again, it's just two candles that stick out like that. The rest here going down like that. The rest here going down like that. I think this is the support zone that it might sink down to. Okay. The top of that is about 2375. 2375. And right now it's at 2530. So it could go down a couple dollars more. And then if I go down a little bit further, the bottom of that zone is about 2175. So there's about a $3 zone there. And that's an area that gold had just kind of moved along sideways there for a while, dipped down, and then started a big rally. If we go into a recession, gold will go up. The deeper the recession, the higher gold will go up. Okay, now let's see here. Let's do this. All right. Could there still be anything unexpected in the Jackson Hole that is not in the pre-release that you read? Yes, there could be. The pre-release that I have, it could be a draft that, you know, maybe had a deadline. He had to send something in, and that's what he sent in. Let's see here. Let's see if I can pull it up right quick. He can always change and say what he wants. So let me bring this over here to the shared screen. All right. So if you go to the Kansas City Fed.org, it's under research and then Jackson Hole. And right here, if you just click on this right here and then scroll down, you go to agenda. And it's right here, 9 a.m. You see Jerome H. Powell, and it says remarks. You click on it, and it's going to give you a PDF. And this is it. Opening remarks, monetary policy in the time of COVID. And, you know, it talks a lot about COVID. 17 months have passed since the U.S. economy faced the full force of the COVID-19 pandemic. That's his first sentence. But when you read through here, the majority of it, and as a matter of fact, let me just do this. This is the easiest thing to do. I think I can just post a link to the PDF right there in the live chat. I think that might work. And we got a title here, The Recession and Recovery So Far. It's interesting that he mentions the recession, but it's the pandemic recession that he's talking about. And we did technically go in a recession during the pandemic. We had 2 quarters of negative GDP growth, negative. But that was it. We snapped right back out. That was like a true V-shaped recovery in the markets, not necessarily for much else. The link worked. Awesome. Glad it worked. So that way you guys can go through and read it. Spending on durable goods has surged while spending on services remains weak. That's because people are going out and buying things. They're buying things instead of services. And that makes sense because during the pandemic, the last couple of years, people have spent more money probably remodeling their homes than actually going out on vacations, lockdowns. So that makes sense. but how's it recovering? The path ahead, maximum employment. That's one of the mandates from the Fed, maximum employment. The path ahead, inflation. That's interesting. Measures of broad-based inflation generally remain moderate, 8.5%. Let's see here. This chart stops at 2021. Let's see. Durable goods. Again, 2021, it cuts off there. Wages. Let's keep going for a moment. Implications for monetary policy. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policy makers not to attempt to offset what are likely to be temporary fluctuations in inflation. You guys can read it. It's a very interesting read. It is a little long. I'll give you that. It's a long speech. And then end notes there. That's it. References. That's it. So you can read that. It's interesting. You will learn something from reading it. I guarantee you. But yeah. So that's taken place. That's taken place. This Friday. Let's see here. What did I want? Nope, I'm good. Okay. Close that out. All right, let's see here. So gold was the last thing we're talking about. Yeah. So if oil can get its footing and start rising again, so can gold. If, for example, the market continues to fall, that could allow gold to rise some. If the recession gets worse, instead of just being a paper recession, if jobs start, if the unemployment rate starts rising, that's a big indicator that the recession is coming, and it's going to be more than just a paper recession. So those are some things to think out. To think about when it comes here to gold, because it has just been falling pretty bad right now. All right, let's see. I got off track here a little bit. That's fine. I would much rather answer your questions than go off of my scorecard here, my notes. Okay, let's see here. Okay, let's talk about semiconductors real quick. Semiconductors got hit pretty hard today, harder than most. And if we're looking on the daily here, I mean, again, so many things closed right on the bottom of its weekly expected move on the very first day. That is amazing that it stopped right there, especially with how far things had fallen. Before I talk about tomorrow, let's talk about the VIX real quick, because it's important. The VIX has been declining, okay? It's been in a nice downtrend, and the VIX is just measuring what the next 30 days of volatility will look like. And when it gets below 20, okay, 20 is still a high reading historically, but you get under 20 and things start to calm down a bit. And as a matter of fact, if you look at the VIX kind of hit its own bottom on August the 12th and started moving sideways. And that closing number was 19.5. So it hung around like 19 to 21 and just kind of bounced there and moved sideways. What is that? About 5 sessions or so. Friday, it started to tick higher. And today, it gapped up and it jumped much higher. What did it close today at? 23.8. If the VIX can, and again, just like the stock market, the S&P 500 and so many others, it hit its 200-day moving average and that caused it to stop. It stopped in its tracks. So can the VIX break above that 200-day moving average? And then if so, its 50-day average is right there as well. So if those two averages are kind of like converging, can the VIX break that? The stock market couldn't break its own 200-day moving average and the other lines on the chart that were resistance. So if the VIX can't do it, and tomorrow will be key. If the VIX cannot break through this tomorrow, and I'm thinking right now that it's not going to be able to do it. I'm thinking the VIX, it jumped today, it spiked today, it hit its 200-day moving average, and that's it. That's where it's going to be for now. And I think tomorrow could most likely be to the upside. I really do. And here's a couple of reasons why. One is the VIX hitting that 200-day moving average, not being able to break it today. If we go and just start running down some different sectors, consumer staples, not quite down there like the rest. Utilities, it's not down there either. Utilities has been really strong. Technology is down there. There it is. It's sitting right there right now. Real estate's been hit hard too, but not quite there. Keep rolling down the list. Just real quick, this is as they load. So we have healthcare, not quite there. Healthcare should be doing pretty decently in the short term here. Financials, big drop. Why? Because the yield curve got steeper today. All right. Consumer discretionary is up next. Right on the line. All right. Industrials. Still has a little bit of room, but it's coming up on that 20-day moving average. And it is possible that some of these that are tapping their 20-day moving average could find support there. Okay. All right. Looking here now at materials, same thing, but it did not hold up above that 20-day moving average. You see that? Hardly a candle today. I mean, big gap. It left a big hole that needs to be filled. But it dipped down below its 20-day moving average. Okay. Let's look at energy. We already looked at that. We saw it's moving up. Nothing to worry about there. Okay. Here we have an interesting case here. This is communication services. There's a lot of mega cap growth in this. Let me open this up just a little bit so we can look at this a little bit better here. Still under its 200-day moving average. This blue line going up and to the right, it's acting as support. Today, it did get slightly underneath its weekly expected move, but it stopped on that trend line. I think communication services could rebound tomorrow, could rebound off of this support line that it made, or that it has, I'm sorry. But again, there's factors that play into this. The VIX is one of them. But if you look at this, just using the weekly expected move only, and again, it is right 68% of the time. It is wrong about a third of the time, okay? So it's not always correct. But the majority of the time, it's a good win rate. But just using the weekly expected moves, look at all the reward we have, and where's the risk right now? In communication services, XLC. There's little risk and a lot of reward right now in communication services. XLC. I am planning to go long starting tomorrow when the market opens, maybe just a day trade, maybe a swing trade. XLC. If the VIX is done, it couldn't break that 200-day moving average today, then right here, we could get a rebound. All right. We already looked at the dollar. I think the dollar is getting almost to an over. Well, let me just pull the dollar up one more time. I'm just going through these one by one real quick. I do think the dollar is getting to an oversold area, if you will, and I think it's going to have a pullback, but there is a potential that it could creep up and break into the 109, close above it, and then have a pullback. I do think that probability is there in play. Okay. RSI right now, 68.7. 70 and above, that's the oversold. It is not right now above its local high on the RSI. That high is probably in 80. And that's when the dollar kind of turns down, when the RSI gets to 80. That's why I think there's a little juice left for the dollar to break 109. Maybe tomorrow it cools off a little bit to allow some of these other ones to recoup a little bit of what they lost today. Or the dollar can just keep charging on, break into 109, close above 109, get that RSI closer to 80, and then potentially pull back. That's a possibility. All right, semiconductors, real quick. It is on the line. There's almost like a, let me do this real quick. I want to go to Applied Materials, AMAT. Applied Materials, I think, has a double top that has formed. I post this on Twitter just as a technical analysis thing here. And I think, or exercise, I think it's got a double top that it's formed. It is now in its support zone. And if it breaks the bottom of the support zone, which is at about $99 a share even, then I think it could make a move and retest a new low or retest its $86 a share low that was set on July the 5th. That's a possibility, okay? Let's go back to semis for a second. And applied materials and semiconductors, when you look at this, because they are in the same, applied materials is in the semiconductor industry, there's a very similar chart pattern here, isn't there? Let's go back to applied material. All right, and then I'm going to go look at this chart pattern, how the candles are, and then I'm going to go to the Van Erik Semiconductor ETF, and the chart pattern is almost there. It's almost perfect. So we could have a double top here for semiconductors, which is going to pressure this to go lower. Now, it hit its weekly expected move today, which the weekly expected move for semis on the bottom is 225.74, and it got to 225.96. So pennies away from that bottom weekly expected move. It did bounce off of that, but like so many others today, it created such a huge gap, and gaps get filled, and that's a huge one. Okay, now let's go to the sectors, and while they're loading, I just want to remind everybody about tomorrow. Okay, there's a couple of reports that we get to tomorrow that are interesting. We get the July new home sales. The expectation is 580,000 units. The prior reading was 590,000 units. So they're expecting about 10,000 units less tomorrow. And that comes out at 10 o'clock. And then we also get the preliminary reading of the ISM market manufacturing PMI and services PMI. The market manufacturing PMI, the prior reading was 52.2. But the services PMI was 47.3. They come out at 9:45 a.m. So tomorrow's open could be a little bouncy for the first couple of hours before it finds some sort of trend and then goes and moves on that. Now, I guess one could conclude here, right? We have the SPX sitting at the bottom of its weekly expected move. It filled a gap today. I can take that out. The SPY also sitting at the bottom of its weekly expected move, filled that gap. I can take that out. The Qs are also sitting at the bottom of their weekly expected move. The DIA, which tracks the Dow Jones, it's also sitting on the bottom of its weekly expected move. And then the IWM, which is small caps, look at this. It's not quite on that weekly expected move. It does have a little candle underneath it, but it did close off of it. So what I'm getting at here is I think there's two probabilities here for tomorrow. What are those two probabilities? Well, with these closing on the weekly expected move, there is more reward than risk, I think, the remainder of the week. I think that's a probability. Unless, of course, the options market just totally gets it wrong this week, which is hard to believe because the options market has a 68% win rate, but it's not out of the probability. Now, it is possible we could bounce off this lower weekly expected move tomorrow, okay? Or we could be rhyming with history here. And on the opening play, the first move, The first move lower, like what happened on June the 9th. Look at the similarity. Let's bring this into focus here. I want to move this up just a little bit. I'll show this on the cues too. All right, come on. There we go. All right, so what am I talking about June 9th? Well, June 9th was this candle right here. What happened after that? Boom, boom. A few sessions later, we hit a new low for the year. Now, this contraction period was rather flat, right? We had a clear top, we had a clear bottom. It was just contracting, moving sideways. Over here, on the other hand, we have this rounding effect at the 200-day moving average. And it's just, remember talking about this right here, this move up here, and then that contraction right there. Remember talking about that and comparing that to what happened back here at the end of May and beginning of June, and how even the day count was the same, green days and red days, going up and then consolidating? Yeah, well, we kind of broke out of that, ran a little higher, left a gap to be filled that, it got filled today, so I can take that gap off. But what if this extra, gap up and run and curl over, what if all this right here was only because of those meme stock, momentum stocks moving in the market? The risk on, the speculative plays, people coming off the sideline trying to catch this rally. What if that was it? Your scared sellers that sell once the market has fallen 20% were the scared buyers here that were FOMOing in, causing this to go higher than it was supposed to go. Maybe, this right here was it. Maybe that's as high as we were supposed to go. But because of that AMC, because of the GameStop, because of the Bed Bath & Beyond, and a whole list of others, because they popped and moved so much higher, maybe that's what helped cause this gap up, move higher, and roll over. And now we're just starting the phase of, well, all right, one tick down, and then we have 2 more big ticks. This is the one big tick. Maybe have a second big tick, and then we have a couple days where we just kind of, bounce around a little bit and hit another low. History doesn't repeat, but history rhymes. Maybe we are rhyming with history right now. Maybe that's what we're setting up for. So it's going to be real interesting to see how the VIX plays tomorrow. Is it going to make it above that 200-day moving average? Is the dollar going to continue to move up? Because if they move up, then the market is going to continue to move down. It's also possible that if they get hung up, then so does everything else, and maybe we get a nice little bounce off of the bottom of the weekly expected move for all of these other stocks, all of these other indices that are sitting right on there, the bottom of the weekly expected move. Maybe we get a bounce off of that tomorrow if the dollar cools off a little bit and the VIX cools off a little bit. If not, then we're going to break below those and we're going to go lower. And maybe we're just front running whatever Powell adds to his speech. And then maybe, maybe it's not as bad as the market is thinking it is. And then we get another rip higher. So those are some possibilities that we have. I know I went a bit long today, but there was a lot to talk about. There's a lot happening in the market right now. And I know more people watch on red days than they do on green days. So I just want to make sure I'm covering the bases here. So everyone is clued in on the possibilities or the probabilities. Now, if we do sink a little bit lower, I don't think that's a bad thing. I think that just means that instead of our risk growing, our reward is growing. So that's how I would be looking at it. Because a 68% win rate, that's a good one to bet upon. And if we go lower one more day, maybe fill that gap, who's not to say we don't bounce back up and on Friday close right back on the bottom end of the weekly expected move when we get outside of it, because that's typically the play that you would make. Of course, that depends on other factors too. I mean, if the dollar is still going strong, if the VIX is still going strong, then, maybe this is one of those weeks, the 1/3 of the time that the options market gets it wrong. Okay. Yeah, my SoFi shares have been getting smoked. Yeah, SoFi, I'll pull that up real quick. And what did I just type in? I hit the wrong letter. All right. So any other questions, go ahead and plug them in now. Otherwise, we'll wrap it up. And I'll talk to you guys in the morning. Our investors on Patreon, I'll talk to you in the morning. And if you're not one of our investors yet, click the first link in the description. Weekly expected moves, 35, 40 different products, numerous trade setups, and also many different styles. So there's a lot there to offer. I think it's very valuable. I mean, everything that I share with our investor community, I use myself. So it's all awesome, I think. All right, yeah, SoFi has been getting beat up. It broke that trend line that it had been using as support, but SoFi can be a speculative stock sometimes, and sometimes the same investors, traders that get in on the AMC trades, they also take SoFi with it. So I'm not surprised to see big swings here in SoFi. This was definitely a steel bar of resistance for SoFi up here. Looking for, some kind of support. Well, it looks like maybe around the 580 down to about a 570. Looks like there could be support in there for SoFi, which is a little bit lower. It's at 608 right now. So yeah, SoFi could definitely go a little bit lower. And then if the market is heading down to test new lows, SoFi could also test its low of the year that was hit intraday on May the 11th, but I think the official close for the low would be on July the 1st. Or it's a toss-up. Maybe June 30th and May 10th. Those might be the toss-ups for the lows. But that's 527 was the closing for January 30th. So we can get there. Long run, I'm holding SoFi. I'll continue to hold SoFi because I think 5, 10, 15, 20 years from now, it won't matter whether you picked it up at $5 or $8 or even $15. I don't think it will really matter that much when you're looking that far ahead for SoFi. All right. Awesome. I am glad to see that. You are welcome. And I'll try to get both of these up. I will add shares at $5. Yeah, that's a good plan. That would be a good plan. If it's getting down there to the 520, 515, so it looks like we have a closing low of 525 and a closing low of 527. So that looks like the low so far for 2022 for SoFi. So, it gets down there to the, 525. I would pull the trigger for that price, especially if it's heading lower and going to retest those lows. Who knows? Maybe it goes lower. You are welcome. Thank you. And let's see what tomorrow brings. And again, if it is red tomorrow, that just means I think that our reward is growing, and we have to look at data to set this up, or we're getting ready to rhyme with history and we're on the first move, like the June 9th move right there. We could be on this right now as the first move. Is the market going to capitulate? I don't know. But one other thing to point out, that's a similarity in why history is rhyming or could be rhyming here, is this first big move down broke below that 20-day moving average that had started to curl up. What happened today? The 20-day moving average that was starting to curl up, was moving up, that was starting to curl over and flatten out, it closed below that 20-day moving average, just like it did on June the 9th. So another similarity. So maybe our run up right here at the end of July, our consolidation right here at the beginning of August, and how it matched up to the expansion move on the end of May and the contraction move at the beginning of June. Maybe this extra little oomph right here was from momentum players coming back into the game, retail investors, FOMO investors. I don't know. There's just so many similarities, and I know history doesn't repeat, but it does rhyme. So we got to be careful tomorrow. I think let's put it this way: we are at a crossroad right now. We're either going to bounce or we're about to capitulate and go down hard. So we got to use the data, and we have to watch it closely, think smartly, and above all else, be patient. Don't rush into a move. Be patient. Wait for confirmation, or wait for whatever strategy and setup you are using. Wait for your rules to be able to be checked off. Because if we are rhyming with history, it's going to be a hard fall down. If we're just in a pullback because we got overextended and this market needs to cool off a bit, then let me hop over here to the SPY real quick. This is my last thing, and then I'll run. I don't want to keep you too much longer. If we're looking at the SPY, probably we filled that gap. There's two other small gaps here on the SPY. One is here, and the other one right there, okay? That is about 405 to 400 on the SPY. If we pull back, that could be an interesting area because the 50-day is coming like this, and it probably start to flatten out more, maybe start to curl down a little bit. 395 is that where the 50-day is? Let me see here. 395 is where the 50-day moving average is. It is possible that we could cool off, and maybe a third scenario, a third probability that we pull back to that 400, 395 area and bounce from there. So there, a crossroads. That's a good word to use. We are at a crossroad right now, and we have to pay attention to the data and technicals to understand which way things are falling. I'm late, but I'll watch the upload. Awesome. Glad you were able to join us. Whether you're late or not, it doesn't matter. You're always on time. All right, ladies and gentlemen, I'll wrap it up here. Thank you so very much for joining me today. I greatly appreciate each and every one of you for spending your time with me here. And remember, if you want more perspective on the market, weekly expected moves, if you want numerous trade setups in different styles of trades, insights on economic data, insights on the market, click the first link in the description. It can also help out the channel. And best thing you can do, click the like button and share this video with a friend. All right, ladies and gentlemen, thank you so very much, and I'll see you in the next video. Take care.